As a real estate investor, you work hard for every dollar you earn. But are you keeping as much of it as you could? I'm Jeff Hampton, asset protection lawyer, founder of STR Law Guys, and fellow real estate investor. I've seen firsthand and experienced firsthand how smart tax planning can save you literally tens, sometimes hundreds of thousands of dollars in taxes each year. In this video, I'm breaking down the top 10 tax deductions every real estate investor needs to know, and stick around till the end, because if you add all of them up together, you could be looking at tens of thousands in saved taxes. Let's dive in. Now, before we get into the deductions, let's take a 10,000-foot view of the types of income real estate generates. Number one is rental income, and this is treated as ordinary income, and it's going to be taxed based upon your current income tax rate. That can be anywhere between 0 to 37%. Number two is capital gains. Here, this is income derived from you selling your property. And usually we're talking about a 0 to 20% on the capital gain side of things, depending upon how long you've actually held the property. Number three is depreciation recapture. In other words, if you sell a property, you may have to recapture a certain percentage of your depreciation that you took earlier, which we'll cover here in just a minute. Fortunately, this is capped at 25%. So we've covered that income, right? This is the way you can make money on real estate. Now let's dive into the types of deductions so that you pay less to the government based on all that income we just discussed. Now here's the kicker. When you talk about deductions, there are two main types. There are cash and non-cash deductions. Let's start with the cash deductions. Number one, repairs. Here we want to think about fixing a hole in a wall or maybe patching a roof. These are specific fixes that were under $2,500. The great thing about repairs under $2,500 is that these are dollar for dollar deductions, which help completely offset any of the gains that you might be receiving from your income. But be careful here, a major remodel cannot be treated as a deduction. Instead, it's treated as an improvement, which now must be depreciated. Use the $2,500 safe harbor rule as kind of your rule of thumb here to know you can classify those smaller fixes under $2,500. You won't run into any problems for taking a dollar for dollar deduction. Number two, professional fees. Here I like to think about accountants and attorneys. Now, those are the two big ones, right? But you'll have all other types of expenses that may apply here. You may have to evict someone. You may have to consider HOA fees. You might have to consider other professional service fees that you have to pay. That would apply here. Anything that's paid to mitigate risk or to manage your properties is going to be deductible. So sit down and think about, is there any professional expense that I have to pay? If so, that can be deducted. Number three, property taxes. Unlike personal property tax deductions with limits, real estate investors can absolutely write off property taxes as a deduction from what they made on the income for their real estate. You say, but wait a minute, Jeff, what if I do the actual calculation for the deduction and it even creates a loss for me? That's fine. Even if it creates a loss, you can still write that off as a deduction on your taxes. Number four, wages, contractors, and management fees. From hiring a handyman to paying property managers or co-hosts if you run a short-term rental. All of these expenses are deductible. Here's a big one to watch out for. What if your property management company nets out your rental income before forwarding it to you? If they do this, make sure you capture their fees as deductions for a write-off on your taxes. Number five, mortgage interest. Now, did you know there is no limit on mortgage interest on your investment properties when we're talking about a tax deduction? Now, I would never suggest that you do this, but even if you financed a rental property on a credit card, all of the interest expense as a result of that financing can be actually written off as a tax deduction on your taxes. Now, let's talk about the heavy hitters. These are the non-cash deductions. Number six, and this is one that will absolutely save you tens of hundreds of thousands of dollars, is depreciation. For me, this is the big one. Now, you need to understand the difference between residential properties and commercial properties. If you're talking about a commercial property, you're up near around 39 years on the depreciation schedule. If you're talking about a residential property under the Internal Revenue Code, you're looking at 27 and a half years. But I want you to realize how important this provision is. Savvy investors use cost segregation to break down the actual value of the asset over a period of time so that you can depreciate as much of the value of rental real estate as possible to limit your tax liabilities. Here's the great part. The Internal Revenue Code has specific provisions for every piece of your property. Foundation, you're talking about the cabinets, you're talking about maybe you have outside decking. Every one of those areas has a different depreciation schedule. If you're talking about like the cabinets, the outside decking, things that are not specifically a part of the foundation or structure itself, those are actually under a different depreciation schedule. And if you do a cost segregation study where you break down the value of a property, you start off with the entire value of the property, you break it down into smaller components of what those values are, you can now write off, instead of 27 and a half years or 39 years, you can now write off sometimes up to a third of the value of the entire property within the first 5 years. And in 2016, when the Trump tax bill went into effect, now that's being sunsetted as at the time of the recording of this video, but there was also something known as bonus depreciation, which means you could actually write off the value of that and not 5 years of that part of the schedule, but you could do it all in one, known as bonus depreciation. Now, currently in 2024, that amount is 60%, not 100%, but 60% of the value of those of any asset within the 5 years. Any part of the structure itself within the first 5 years of that depreciation schedule can be written off. But now, depending on what happens now in 2025, we could be seeing a return to 100% bonus depreciation. Number 7, capital gain exclusions. This is where I love the 1031 exchange. Under a 1031 exchange, let's say you bought a property 5 years ago, and now you're ready to sell, but move into a like kind. It either needs to be the same value or greater value in asset. You can now, as long as it's a like kind asset, you can now actually sell the first property, and you can actually move over that cost basis into the next property. You can defer the capital gains. And there's this old saying that you can 1031 until you die. If you continue to use the 1031 exchange principle, you can actually not ever have to pay. You can avoid those capital gains expenses for selling a property. And then the great thing is when you die, your estate receives those assets with a stepped up basis. So you can completely avoid the capital gains. That's a tax-free transfer of wealth to your heirs. So never disregard the 1031 exchange as a potential strategy when you're looking to sell rental property because you want to avoid paying that tax if you can. Number 8, active participation and professional real estate status. If you are actively involved in the management of your properties, or if you run a short-term rental, it's known as the material participation test, you can actually write off the losses, the passive losses, that depreciation we talked about. You can actually write it off against your other income. So it can apply not only to your rental income, but it can actually be written off from other income sources as well. But this is only if you qualify as a real estate professional under the Internal Revenue Code, or you meet the material participation tests if you own a short-term rental. Now, I'm going to tell you personally, and I've dealt with many doctors, lawyers, I deal with a lot of entrepreneurs. This is a game changer if you are a high earner. Number 9, home office. Now listen, if you have a dedicated space within your home and you use it for business purposes, you can write off a portion of your utilities, your taxes, as well as the actual mortgage portion of what you pay for that square footage of your home office. That can be a deduction that comes off of your taxes. Better yet, structure your business with a management company, and it can allow you to unlock tax-free reimbursements. Finally, number 10, pay your kids. If you have kids under 18, you can pay them to help you in your business. Think social media, think photography, think guest interaction, think tenant assistance, you name it. It's pretty much endless. As long as it's a normal business activity, you can have your children be involved in it from start to finish. For example, I have a business that I do this with in the production of these videos for you here today. I have my son who helps me not only with the editing portion of this, but he helps with putting together the scripting portion and the actual lining up of the videos to be launched on this channel. You can pay them up to the standard deduction threshold, which is more than $14,000 a year. Here's the best part. It's tax-free for them, and it's tax deductible for you. That's right. Think about this for a second. When you pay your kids and you structure this properly, you're effectively moving income from a high tax bracket to a zero tax bracket. These strategies aren't just loopholes. They're actual strategies to help you keep more of your money so that you can turn around and reinvest it and buy more rental real estate. Now, let's say you buy your next rental property and you're concerned because it's a short-term rental. And what if someone turns around and tries to blame you because they got hurt on your property? Check out this next video where I break down exactly how you can protect your rental real estate from greedy lawyers. I break it all down. See you over there.